Bismillahirrahmanirrahim. In the previous class, we discussed about factors affecting international portfolio investment. Today, we are going to discuss factors affecting DFI. So these are the factors that are affecting direct foreign investment, majority stake, more than 50% shares. The first one is changes in restrictions. New opportunities may arise from the removal of government barriers. Now see, this is a country in which people have a huge sum of money. They want to invest it. There are good companies, rich companies in this country, Afghanistan, and the people and the companies, they want to invest it, so they will invest it in those countries in which the government made the restrictions on foreign direct investment. They made restrictions soft. Restrictions, they are inviting people, these countries, they are trying to invite foreign investors to their country to invest money in our country. They made taxes low, they made the law and order situation good for these investors, and they reduce they provide different facilities to these foreign investors. These countries, suppose this is China, this is Vietnam, this is USA, and this is Australia. Now suppose in China the tax rates are low, tax havens. Suppose the availability of raw material, it is easy here in China. Suppose the labor force is cheap here in China, and different other facilities. Government is providing different other facilities. Suppose from their local companies they are charging 40% tax, but from international investors they are charging 30% tax. So this is what? They made their restrictions soft. So because of this, investors from this country, they will move to China. Here in these countries, the restrictions from government, it is not soft. Same is the case here and same is the case here. So foreign direct investment will tend to move to that country in which the government made restrictions soft. If the restrictions are soft, so foreign direct investment will tend to move to that country. The next thing, so see, changes in restrictions, new opportunities may arise from the removal of government barriers. Now, government remove barriers, so because of that, now foreign direct investment, more foreign direct investment will come to that country in which government removes restrictions. The next thing that is affecting foreign direct investment is privatization. DFI has also been stimulated by the selling of government operations. Take an example. What is first of all, what is privatization? Suppose this is Afghanistan. These are other countries. Privatization means that here in Afghanistan, suppose there are government owned institutions. Government owned institutions means those institutions whose ownership is with government. Now, what is government doing? Their performance is not good, so government is selling those institutions, those government owned institutions. So, when government sells those institutions, we call it privatization. Now, when government sells those private institutions, foreign investors will move to that country to purchase those institutions. I will give you an example. I don't know about, I have very less information about Afghanistan. I will give you an example from Pakistan. This is Pakistan. There is an institution by the name of PTCL, Pakistan Telecommunication Company Limited. PTCL was a government owned institution. What happened? Government sell this institution, but they sold only 49% shares of that PTCL. So a company from Dubai, I think Dubai or some other country, I don't know. Dubai, you know about that company. That is in Afghanistan, it is by the name of Etisalat. Now, what that company did, they purchased that 49% shares of PTCL. So what happened? Due to privatization, a company from Dubai came to Pakistan and they purchased 49% shares of PTCL. Basically, I don't know it is 49%, it is 51%. I think it was 51%. So what happened? Due to privatization, a company from Dubai came to Pakistan and purchased 51% shares. So privatization gives opportunity to foreign direct investors to come to a country and purchase and make foreign direct investment. Now, there is a third reason, potential economic growth. Potential economic growth means expectation in economic growth. Countries with higher potential economic growth are more likely to attract DFI. Keep in mind, if companies are expecting that the economy of a country will become strong. Suppose companies and people in Afghanistan, they are expecting that these are three countries, we want to invest our money in these three countries. So we will select which one. Suppose this is USA, this is Pakistan, this is Australia. Now, suppose the people and the companies in Afghanistan, they are expecting that the economy of this country, it will become strong in the future. There will be growth in the economy of Pakistan in the future. So what will they do? They will invest their money here in Pakistan. Why? When the economy becomes strong, demand will increase. And when demand will increase, so there will be an opportunity to produce goods and services. Produce goods and services. So when demand will increase, production will increase. When production will increase, profit will increase. Sales will increase, and when sales will increase for a company, their profit will go high. So if there is expectation that there will be growth in the economy, there will be growth in the economy of a country, so foreign direct investment will tend to move to that country. The standard of living of that country will become good when the standard of living of that country, with economy standard of living, it is becoming good, better and better. So when standard of living is becoming better and better, then demand of goods and services will increase. When demands will increase, production of goods and services will increase. Companies will expand their operations, they will produce more goods and services, and when they will produce more goods and services, their sales will increase and their profit will increase. So this is because if the economy of a country becomes strong, so then companies will invest their money in that country. Then the next thing is tax rates. We already discussed that in portfolio investment. Countries that impose relatively low tax rates on corporate earnings are more likely to attract DFI. We discussed that if in a country the tax rates are low on profits, on corporate earnings, suppose in Pakistan the tax rate it is 30%. In USA corporate taxes are 40%. And suppose in Australia it is 20% on corporate earnings. So investment will move to that country in which the tax rates are what? Low. Corporate earnings will move, corporate investment or FDI will tend to move to that country in which the tax rates on corporate earnings are low. Here it is 20. Suppose you earned 1 lakh. Corporate earning is how much? $1 lakh. So here in Pakistan, from 1 lakh 30%, you will pay 30,000 tax to the government, $30,000. Here in USA, it is 40%, so you will pay $40,000 to government. And here in Australia, you will pay only $20,000 to government on your profit. So here 1 lakh minus 30,000, you will get a profit of $70,000. Here 1 lakh minus 40, so you will get $60,000 profit. And here in Australia, 1 lakh is your profit, you pay 20% tax, that is 20,000. So 1 lakh minus 20,000, you will get $80,000 profit. So this is about the taxes. If the tax rate is low, your profit will be high. In Australia, the tax rate is 20%, so your profit is $80,000. In USA, the tax rate is 40%, so your profit will be how much? $60,000. And here in Pakistan, the tax rate is 30%, so you are getting a profit of how much? $30,000. And the last thing that is affecting DFI, that is direct foreign investment, is the exchange rates. Firms will typically prefer to invest their funds in a country when that country's currency is expected to strengthen. Just like we discuss it here, few people remind exchange rate, portfolio investment. That is, if a country's currency becomes strong, so we will invest our money in that country. Same is the case here. Foreign direct investment will tend to move to that country in which whose currency is expected to become strong. If the currency of that country becomes strong, what will be the impact? The impact will be that our profit, when we will convert profits back to local currency, then our profits will go high. If you didn't understand this thing, then check the previous lecture. It will be much more clear to you people. We already discussed that thing there. Now, agencies that facilitate international flow of funds. There are different agencies internationally that are facilitating the international flow of funds. Following are the agencies which facilitate international flow of funds. One is IMF, International Monetary Fund, World Bank Group. In World Bank Group, there is IBRD, IDA, IFC, MIGA, and ICSID. Then World Trade Organization, WTO, BIS, Bank of International Settlements. Then regional development agencies. There are different regional development agencies like Asian Development Bank, like African Development Bank, European Development Bank, etc. So I'm not going to explain it here because you people already studied this thing in international business. Here it is given, you can study it yourself. IMF, World Bank, IDA, IFC, MIGA, ICSID, World Trade Organization, Bank for International Settlement, regional development agencies like I told you, American Development Bank, Asian Development Bank, African Development Bank, and European Bank for Reconstruction and development. So it is your, you can say, homework. So you will study it yourself. In this chapter, what we discussed about balance of payment, current account, capital account, and financial accounts, international flow of funds, international trade flow, international portfolio investment, and direct foreign investment. Then we discussed about factors affecting international trade flows, inflation, national income, government restrictions, exchange rates, international capital flows. We discussed about factors affecting DFI, factors affecting portfolio investment, and then agencies that facilitate international flow of funds: International Monetary Fund, World Bank, World Trade Organization, Bank for International Settlements, and regional development agencies. So, inshallah, in the next class, then we will start the next chapter. So, for today, it is enough. Assalamu alaikum.